Welcome to the Real Estate Guys radio program. Thanks for tuning into the show today. We've got an amazing set of guests, and they're you, our listeners. Today, we're taking questions from the audience. It's Ask the Guys. Your questions, our answers. Today on the Real Estate Guys radio program. If you've been listening to the Real Estate Guys for a while, then you've heard about the legendary Investor Summit. Simply put, it's the highest level event we do, and the content, faculty, and attendees are amazing. If you're serious about taking your real estate investment to the next level, consider joining us. You'll spend an entire week with like-minded investors, world-class educators, and real-world professionals, and you'll have a blast. It all begins April 1st, 2017 in Houston, Texas. Summit alumni have already booked 60% of the cabins, but public registration is now open. Visit realestateguysradio.com and click on the tab that says Summit to learn more. We spend 2 days on land learning and networking, then jump aboard a luxury cruise ship for 6 more days of classes, roundtable discussions, great dinner conversations, and a ton of fun. Go to realestateguysradio.com and click Summit and make plans to spend a week with the Real Estate Guys and an all-star faculty on the 15th Annual Investors Summit at Sea. Welcome to the Real Estate Guys radio show. I'm your host, Robert Helms. With me, as usual, co-host financial strategist Russell Gray.
Hey, Robert.
One of the favorite things that we get to do every couple of months is answer your questions. And today it's Ask the Guys. And what happens is folks think of things as they're out there living their lives and they send off emails to us. And you basically go to our website at realestateguysradio.com and click Ask the Guys. And we get such a variety of things that come in. One-line questions, giant books of information about people, soliciting for mentions, all kinds of things happen there, but we get some really, really good questions. So one of our favorite things to do is to answer your questions. We've got a bunch of them today. Here's the only disclaimers we have. We are not tax professionals or attorneys. We don't give advice. We simply give information and ideas for you then to go to your professionals and vet out. So that's our only disclaimer. With that, let's go. Our first question comes from Andrew in Portland, Oregon. He says, I'm a union carpenter looking to get into real estate investing. I listened to your podcast about flipping houses and was wondering if you would recommend flipping a property or buying a house and renting it out for a first-timer. I have been renovating houses and in the construction field for 15 years, and I'm tired of putting in a lot of hard work on someone else's property and getting a paycheck while they get the profit. You guys are full of great info, and your show is wonderful. Keep up the good work. All right, well, first of all, thank you for your kind words, Andrew. That certainly got your letter to the top of the list. But this is a great dilemma you have. So we talked a little bit, if you didn't hear the show on flipping, we don't regularly flip properties. That's not our business, although both Russ and I have done that. In our mind, flipping a property is not real estate investing. Flipping a property is a great way to make some money. If you know how to buy right, if you know how to estimate correctly, and if you can add value in such a way that you get more than that back in sales price, and you're smart about hiring a great agent, marketing the property, finding a buyer, and you can preserve some profit, awesome. You can do that again and again and again and have these repeatable base hits and make a ton of money. All for that. However, it's not real estate investing.
Well, right. The essence of business and investing is to accumulate the efforts of others. They get up every day, they go to work, they produce something of value, and you get a piece of it. You can do it by lending to people, and then they pay you interest out of their earnings. You can do it by renting to people, and they pay you rent out of their earnings, whether it's a company or an individual. You can do it by hiring an employee and making a profit on their work product, which is what you do when you run a company. But the key is in business investing is to build a machine, create a portfolio that accumulates the efforts of others. Whereas flipping a house means you're going to take your capital, you're going to purchase an asset, you're going to do something to make it worth more, a spread, if you will. Buy low, sell high. When you cash out of that asset, you're going to have cash. So your round trip is cash to asset to cash. And then you've got to repeat the process to create cash flow. And the efforts that you're exerting are your own, not others. Now, can you do that through others? Yes, that would then make it a business. I have a business where people flip houses and I own the business. They do the work. I make the money. That's a lot harder to build. You can certainly do that. Sounds like, Andrew, with some of your skills, you could. But you said, should I do this or should I do that? My response would be, do both. Use your skills and use flipping as a way to create down payments. And then you flip a couple houses and then take the money and purchase one. Or you flip a couple houses and then on the third one, you rehab it and then tenant it and then keep the income. and then you do a couple more and you make another down payment and you keep another one. We have a good friend, Terry Kerr, in Memphis, Tennessee, and he's done that, and he's built a portfolio of I don't know how many hundreds of properties he has personally, property management company he built to support that, and then the houses that he flips to support the people he flips to. So he's built a big, thriving business in Memphis with exactly your same skills, following your exact same model. So you can be small and just do one at a time and collect a small portfolio, or you could also build a big company like Terry has and serve a lot of other people. It's totally up to you. But it sounds like you've got the ambition and you've got the basic skill set. Now you just need to go out there and get started.
Yeah, and the idea of investing, you say, I would like to learn to get into real estate investing. That's what investing is. It's putting your dollars out to work instead of your labor out to work. And I think you absolutely can do both. In fact, you might even look for opportunities where what you do is find a property that needs a lot of work. You have the skills necessary to do the work, and then you keep it as a rental property. Then you don't have the transaction costs, the sales commissions, those kinds of things. When you sell, it costs you a lot, right? Every time we sell, we have 8 to 10% that goes out the door to all those fees. So if you can capture that and keep it, that could be a great thing. Big picture is this. How many individual properties can you be flipping at a time as a guy who's got construction experience? You know what that number is. How many passive rentals can you own at a time? For most people, they can flip 1 or 2 properties at a time. They can hold a dozen, 5 dozen, 300, 1,000 homes. You get professional management. Now, to Russ's point, you could build a business of flipping. Not too many folks have been able to successfully do that because the people doing the work don't have the heart and passion generally as much as the business owner, and sometimes the margins just aren't there. So acquiring real estate long-term to have production of income, other people's efforts, makes a ton of sense. You just happen, Andrew, to have skills that could get you in the door in a very different way.
Yeah, and you don't have to use the skills in terms of actually performing the work. You can use the skills to hire quality work and recognize quality work and negotiate good deals, or to build a company if you chose to do that. Completely different path to creating cash in order to have down payments to build a portfolio is to raise private money. So now you rely upon your background as being a professional in a business who understands how to look at a property and create value in a property, and then you market that to your investors who put up the capital. You provide the labor or the oversight on the labor. They provide the capital. You create equity. You take a portion of your profits and then use that to accumulate a private portfolio. So that would be another way to do the same thing. We have our seminar, The Secrets of Successful Syndication, which we did not too long ago, but we're doing again in March of 2017. So if that's something that's interesting to you, Andrew, come on out and join us. We'll teach you how to do it.
All right, good stuff. Our next question comes from Sonia in Pembroke Pines, Florida. She says, hello, thank you so much for taking my question. As of today, I have $32,000 in my savings. I know that's not very much, but it's growing. And I'm able to use the VA loan to purchase a home, so no down payment required. I live in South Florida, and it's pretty expensive here. I sold my home in Denver, which was a mistake, I think, and relocated here due to my marriage. So my question to you awesome guys is, in my current position, do you think it's best to buy a home in Florida before buying an investment property? My idea was to look into purchasing a single family or multifamily unit and renting it out while I continue to save money for a single family home. What should a smart woman working towards her early retirement do? P.S. I'm renting now because it's tough finding an affordable home in a nice area within the budget I'd like to stay in and in order to be able to invest later. Thank you, Sonia. Okay, well, some great stuff here, and I think this applies to a lot of folks, which is why we selected this question. Just so you know, if you submit a question, we don't answer it. Nothing personal. We just try to get the ones that lots of people are going to get benefit from and not a unique situation. And this is a pretty common situation. Do I invest first or do I buy a home first? And there's reasons to go either way, but we definitely have some thoughts.
Well, first of all, I'm really glad that selling the home in Denver was the mistake and not the marriage.
Yes, absolutely.
So congratulations on that, and I hope you're enjoying South Florida. In terms of your personal residence, that's a choice that you make based on where you want to live and the type of property you want to live in. If you find that for the amount of rent that you're paying, you can get a much nicer home than you could for a comparable mortgage payment, especially when you factor in the down payment. Now, in your case, you don't need to make a down payment because of the VA, which is fabulous. But that also means you're going to have a bigger mortgage, which means you're going to have a bigger payment. You will pick up some tax breaks probably check with your own tax advisor in terms of the mortgage interest deduction if you go down that path, but you're also tethered to the property. And it sounds like your move to that part of the world was recent. And so the idea to put down roots and buy a property, buy a home to live in, if you think there's a possibility you might be moving at some point in the future, you may not want to do that unless you felt comfortable that you could retain the property and it would be a profitable rental. And the reason I say that is because we found out about a decade ago that housing prices can change and you may end up getting stuck in a property you thought you would be able to sell when you were done owning it. So don't assume that just because properties have been going up, they've been going up for a long time. You mentioned specifically that housing in your particular area has gotten very expensive. Well, sometimes when housing gets very expensive, it doesn't mean it's going to keep going to the moon, at least not in a straight line. And if it decides to pull back and you're stuck, because if you think about it, when you buy a property with no money down, you are 100% financed. To even sell the property for the same price you bought it for, you're going to be minus 6 to 8%, which means the only way to get out is to write a check. So think about that. So if you think, okay, if the property goes up 10 or 20%, then I could get out with a modest profit. Is the amount of profit you would make based on the amount of responsibility you would have for maintenance and upkeep, based on the chance that you could be trapped in a property that you may or may not want to keep for the long haul and may or may not be a suitable rental? Is that risk worth the reward? I'm not so sure. Then you say, okay, I could take my savings and I could take my VA and I could go somewhere else and do something that would be a more suitable investment. So we really can't say what you should do. It's going to be a personal decision. We're just giving you some food for thought to think about the upside. Everything in investing is about risk-adjusted return. It's not just return, it's risk-adjusted. And some of the risks when you're talking about your home are personal and lifestyle and commitments. And that's hard to quantify, but you got to kind of put it in the blender and figure it out.
I say live where you want to live and invest where the numbers make sense. If it makes sense in your area that this home that you're living in could be a great rental property once you move out, then it might be worth that nod. The challenge is you've got this VA loan eligibility, great thing, but it's for a primary residence. So you're not going to be able to use your VA loan to go buy an investment property, at least not initially. Once you buy a property, and again, you want to get counsel on this, once you buy a property using a loan that's a owner-occupied loan of any type, that loan can stay in place once you move. If I move with my family into a home and we live there 3 years and I decide, you know what, we're going to keep this house as a rental, I buy another home as an owner-occupied home because the rates are better and less down payment and so forth. Nothing says I have to go back to the lender and say, oh, I no longer live in the home, so just my interest rate. That's not how it works. But you can generally only have one VA eligibility at a time, meaning say you bought a property in Florida with your VA loan and you decided to move and keep it as a rental. You could do that and you could keep that loan, but you couldn't buy your next home with the VA loan and no money down. So there's a lot to think through here because it's not just about how long you expect to be in the area and what the market's like. It's the other markets where you might be interested in buying and what those returns might look like. So you got to have your investor hat on for part of the decision, and then you've got to have your personal hat on for part of the decision and decide, is this a place we want to stay? If you have any uncertainty about being there long term, there's really no harm in renting today. Where the rates are and where loans are and all of that, renting for a while to figure it out is great as long as you put the assets to work to create income from investment property at the same time.
Yeah, I totally agree. And with $32,000, which is good. Congratulations. Great job that you're savings. A lot of people are having a difficult time right now. If you look at the statistics, many people in America don't have $400 or $500. So congratulations. You want to be smart with it. With that said, if you do take on the responsibility of becoming a landlord, you do occasionally have unexpected capital expenditures. You need to replace a roof or replace a carpet or a dishwasher or a hot water heater goes out and you've got to replace it. You have an obligation to your tenants. And so, you've got to have both the down payment, you have to have cash reserves to satisfy the lender, and you're going to have operational contingency reserves. With that type of budget, you may want to segment a little bit aside for the travel and the due diligence you're going to need to do in order to explore the markets and build the team, and focus on the market and the team more than looking at properties. Focus on the market first, make sure the market makes sense. And we have many episodes we've talked about this. So dig up in the archives things where we've talked about market exploration, and then go out and build a quality team that can help you find properties. On the other side, you may think about this, and this isn't for everybody, but you may think about partnering with someone. If you know someone else who's similarly interested, maybe you guys could do something something together. It's not really a syndication. It's more of a little alliance. If you and your best friend go together and buy a property, you both have $30,000, which isn't really enough to be completely where you need to be as an individual investor, but the two of you together could get that first piece of experience and have the camaraderie of going through it together. If you decide to go down that path, don't just pick somebody because you trust them. Pick somebody because you think they do good business. And if somebody does good business but you don't trust them, well, don't do business with them either, right? You've got to trust them in both their competency and their ethics. So there are a lot of different ways to approach this, and you're probably eager to get going. And we're always advocates of taking action, but you also want to be very thoughtful, right? Don't just pull the trigger and just go out there, because, you don't have a big backstop with that kind of a balance sheet. A bad decision could cost you a lot. So make sure you're investing in some education, hanging around with active real estate investors. Take your time and find a way to network into places where there are active real estate investors, and you can learn more about the nuts and bolts of investing.
It's your questions, our answers. Ask the Guys today on the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Are you ready to profit in paradise? Hi, it's Robert Helms, and if you think real estate investing means tenants, toilets, and termites, think again. Located just a short plane ride from the U.S., a virtually untouched paradise awaits, the beautiful country of Belize. When you go to Belize with the Real Estate Guys, you'll spend 4 fabulous days discovering one of the most intriguing real estate markets I've ever seen. With its jungle rainforests, pristine beaches, and 81-degree turquoise water, Belize is one of the most beautiful places on earth. Plus, it's considered one of the top 7 tax havens in the world. Belize property is on the rise, and many experts think the best is yet to come. But don't just take my word for it. Come experience Belize firsthand at our upcoming investor field trip. When you join us, you'll discover the many reasons we love Belize, like tremendously undervalued beachfront land, super low taxes, ease of doing business, and so much more. Get the details at realestateguysradio.com. Just click on events. See paradise for yourself. Click events at realestateguysradio.com, and I'll see you in beautiful Belize.
Hi, this is Donald Trump, and you're listening to the Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. It's your questions and our attempt at answers on Ask the Guys today. If you have a question for the Real Estate Guys, go to our website at realestateguysradio.com. Click Ask the Guys. This one comes from Rick in Livonia, Michigan. He says, first, I love your podcast and listen to it regularly. I started listening about a year ago and often review your earlier shows that I did not previously hear. I have a syndication question. Listed below is a brief summary. I'd like to raise money through a syndication and buy turnkey properties in 4 to 5 different markets with 4 to 5 properties in each market. I would focus on single-family homes, duplexes, triplexes, and quads in U.S. cities, as well as 1 or 2 vacation properties in Belize. All the properties would be turnkey except the local markets near me, in which I would manage this group of properties myself. My time frame would be 10 to 15 years. And over this time frame, investors would receive cash flow up to the day we sell the last property. What are your thoughts? Thanks, Rick. All right, well, great question, great way of thinking. Syndication is putting together lots of different people's resources to do something bigger. You might not be able to get a portfolio of 25 properties yourself immediately, but if you raised the capital to do it and wanted to manage that, you could. So I think at the high level, love the idea. There's some diversification across markets, which is great. There's diversification across property areas and submarkets and property types. I think that's great. So I like that part of it. I even like the fact that you're throwing in some vacation property just to give your fund a little different flavor. I'm not too sure about the idea of managing some yourself.
Well, there's that. And again, maybe that's not bad, but if you're going to be attentive to what's going on in the other markets, you just need to make sure that you are really mindful of budgeting your own time, because you're managing both money, but you're also managing time. And time is even harder. You can't raise more time. What you can do is make sure that you're using the time you have wisely. And when you're doing things hands-on that you can hire other people to do, if there's room in your business model in the other 4 markets, then in the 5th market you're in, there's room in your business model too. So if you do it because you think that it makes you better at interacting with the managers at the other locations and it adds value in that regard, I would say, consider it. If it's because it's a way that you think you can make an extra 5 or 10 points on a portion of the portfolio, I would be careful with that. And the other thing is when you're handling other people's money, you always have to disclose every conceivable way that you may be being compensated. And so you just want to be sure, if you decide to do this, that your investors know that you're going to be receiving a property management fee. You're not going to be as prone to fire bad property management on behalf of your investors if you're the property manager. So you're putting yourself in a position of conflict of interest.
Well, you are, but that also could be some of your credibility. If the investors that you're talking about know you because you're in that business, and that could be a reason you have credibility. If I'm looking at this as an investor in your fund, there's 2 ways I could think about it. One is that, hey, you know what? He's got some experience in property management. That's a great benefit in that market, but not in the other 4. That could be a negative. Or if I'm thinking, well, that's kind of a conflict of interest, right? To me, there's more negatives in you doing the management yourself, time being one of them, than there are positives. Not to dissuade you from doing it. There are reasons to do it, but that's just kind of my first gut. The other part of it is this. If you are putting together a portfolio of houses, unless you're going to buy them for all cash, you need to be thinking strategically about the financing, because it's going to be very difficult for you as a single person or as an entity to get financing on 20 to 25 properties.
Yeah, you may have to recruit credit partners and build them into your model, and you can certainly do that. There are people running around with credit scores that would be happy to get a piece of the action for securing the debt, and that can be done. Maybe some of your private investors would be willing to do that too. You're going to have more responsibility, because it sounds like this is probably going to be run more as a fund rather than a deal. So when that happens, the management decisions that you make to buy, sell, and the different things that happen on a project, you can't predict ahead of time really what you're going to do. You don't have a pro forma for it. You're going to be reacting. So you have management decisions that you're going to be making along the way. And so you are going to have more exposure to making good decisions. In other words, liability or the expectancy of people to make good decisions. So I think that's one thing to think about. The only other thing I really have to say that I think is important is I love the entire plan except for one thing. I think, as our friend Simon Black would say, add a 0 to your thinking.
Right.
I think when you factor in the amount of cost to travel and manage just 4 or 5 properties in a portfolio, to do the due diligence in each individual market, maybe be diverse in 3 markets and have 8 properties or something like that. Or if you're going to go have 10 or 12 or 15 in each market, because once you figure out how to do this, it should be scalable, because it's going to take you time to go into each market, do the due diligence on the market, paper your file so you can explain to your investors why this is a good market, why you've selected it. Then you're going to go need to build a team and build a relationship with the team. And of course, the more business you're bringing or promise to bring will give you a better shot at a better team and a better shot at their loyalty. If the only gating item is the amount of money, that's largely a mental block. And if you just open your mind up to the idea that instead of asking a bunch of people to make a $10,000 or $20,000 investment, you get a bunch of people to make a $200,000 or $300,000 investment, the amount of work you have to do is the same. The only difference is who you're talking to and how you're talking to them. And when you develop that, then it's easy to add a 0 to your thinking.
Different ways to set up funds like this too, and that's what you have to be thinking about, Rick, because if you set up a closed fund, you're raising $1.5 million, and that gives you an amount of money to go get a number of houses. That's one way to do it. In fact, that's probably the simplest way to do it. The other way is to have an open fund, where as you find more opportunity in the marketplace, you can raise more money. That's a whole heck of a different investment, and it's not bad. It's a way to add a zero. It's a way to be smart. It's a way to, scale, but it is some management and timelines and what happens about the guy who invested 3 months in and the guy that invested 2 years in and somebody wants out. How do they get out? How liquid are the properties? Can they get out? There's a lot to think through. I think you have the bones of a really great business model here. You just got to take some time and really strategize about the markets, why, the term 10 to 15 years there's a difference between 10 years and 15 years. Maybe it's an ongoing fund. Maybe people can get out. Lots to think about, but good stuff. Our next question comes from Everett in Coral Gables, Florida. That's 2 for Florida. I love your podcast and have listened to many. In the summer of 2015, you made a series of 4 podcasts with advice on getting into income real estate. In the second podcast, June of 2015, Choosing Your Markets, you mentioned 5 primary indicators of a market to look for. From your presentation, I got 3 indicators for sure. Number 1, rent trend. Number 2, occupancy. Some people call that vacancy. Number 3, absorption. And those things work together. I didn't follow the presentation for the last 2. I believe they were net in-migration and days on the market. Can you clarify? Thank you for your podcast and events. I'm sure I'll be signing up for some of your events to help in my investment future. All right. Well, Everett, good stuff. Wow. Awesome. You listened through that series and we were definitely talking about markets. So
apparently took notes trying to make order out of our blabbering.
That's pretty good. So let's talk about these 2. One of the most important metrics I look at on any market is net in migration. Every day in every market, people are moving out and they're leaving. And the net of that is either positive or negative. There are markets right now in every country on earth where more people leave every month than come in. That creates a certain real estate investing environment.
Well, let's talk about that for just a minute, because if you want a case study in that, look at Detroit, Michigan. Detroit, Michigan, in its heyday, was a 2 million population city. It was the richest city in the United States, and it had housing and infrastructure to support all of that. Today, it's probably closer to 600,000 or 700,000, maybe 800,000. And so they're literally tearing houses down because they're just blights. They're not occupied. They're being squatted in. Nobody's maintaining them. And so they're actually having to remove inventory, and the prices drop to the point, and I don't exactly know where it's at because we haven't looked at Detroit in a while, but there was a point just a few years ago where literally you could pay $500 to get a home. A physical home, an improved property, with functional plumbing and electrical, well, allegedly, but for $500, we were just trying to get rid of it. Please, somebody take this and own it and take care of it, because it's more of a liability than it was an asset.
And frankly, at $500, that might have been too much to pay.
But that's because the people left, and that's the point of this. That's why migration, that is an exaggerated scenario, but what happens is these markets shift slowly based on these underlying economic trends, and if you're not paying attention to them, you don't see the shift until everybody's starting to head to the exit. And so if you're late to the exit, that's when you get left holding the bag. If you're paying attention and you recognize a mega trend like that, you begin moving out early and you get out while the getting's good.
So what we look for is positive net migration, where there are more people moving in than out, and they're moving in for the right reasons. It's not just more people are moving in. They have to have jobs. They have to have the right kinds of jobs for the type of real estate you're interested in, and they have to have vibrant reasons to be there. And that's what we look for in a marketplace. So that's net in migration. And then days on the market is this. We can judge a real estate market's health by the average number of days it takes to sell a particular type of property, whether it's retail or commercial or typically a single family residential is the easy one to find out. But if you tell me that in your market, it's taking an average of 150 days to sell a home, and last year it was 120 days, and the year before it was 90 days, then I can see the trend. And so I want to look at not just annually, but from a month-to-month basis, and not just at a market like Detroit, but at a sub-market level. What is the average days on the market? That gives me the health of a market. Now, those are what we call the 5 primary indicators, but there's a whole bunch of other indicators that are beyond the scope of this show, but that's to clarify those points. So good stuff. It's your questions, our answers. When we come back, it's time for us to ask you a question as we play Real Estate Trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Are you achieving everything you want in life? What if there was a time-tested way for you to get everything you've dreamed of? The most successful people in life set goals and keep themselves accountable. But how? The good news is that it's not rocket science. You too can learn the skills and unleash the motivation that will create success in your life. And now is the time. Hi, this is Robert Helms, and I'd like to personally invite you to attend Create Your Future, the 2017 Goals Retreat, January 6th through 8th in beautiful San Diego, California. This unique weekend has been called phenomenal, inspirational, and life-changing by the hundreds of people that have attended. Find out more at realestateguysradio.com and click events or call 888-489-7723, extension 18. Get your life back on track physically, spiritually, and financially. Attend the 2017 Goals Retreat on the first weekend of the new year. Click events at realestateguysradio.com to register. This is no dress rehearsal. Live the life you were meant to. Visit realestateguysradio.com or call 888-489-7723, extension 18 today. Forbes rated Memphis the best cash flow market in the nation, and our good friend Terry Kerr at Mid-South Home Buyers has been the premier turnkey rental property provider in Memphis for over 13 years. With an A-plus rating from the Better Business Bureau, Terry has renovated over 750 houses. Real Estate Guys listeners have snapped up hundreds. Discover what these satisfied investors already know. Mid-South's properties are completely renovated with a 1-year warranty and a lifelong rental guarantee. They're affordable, well-managed, and easy to own. Perfect for beginning investors and veterans alike. Get in on the action. Contact Terry and his team via email at midsouth@realestateguysradio.com.
Hi, this is Lawrence Yun, Chief Economist with National Association of Realtors, and you are listening to the Real Estate Guys.
Welcome back to the Real Estate Guys radio program, heard every weekend on this fine radio station, all the time on realestateguysradio.com and your favorite podcast outlets. We're happy you're here. It is Ask the Guys. You're asking us questions, and we're answering as many as we can. We can't get to them all, but if you have a question for the Real Estate Guys, we'd love to hear it. Just go to the website at realestateguysradio.com and click Ask the Guys. Before we get back to our next question, it's time to play Real Estate Trivia. That's your chance to win a prize by knowing today's Real Estate Trivia question. In just a minute, I'm going to give you a question, and your job is to come up with the answer to that question. And if you do, you're going to get a copy of Robert Kiyosaki's great book, Second Chance. That's his latest, and it can be yours if you know today's Real Estate Trivia question. Last week on the Real Estate Guys, it was our annual Halloween edition of Halloween Horror Stories. We asked this: Stephen King's inspiration for his book, The Shining, came from staying at which hotel? Well, the answer is that Stephen King and his wife Tabitha stayed in 1974 at the Stanley Hotel in Estates Park, Colorado. Turns out they were the only guests in the hotel because they were just about to close for the season. Sound familiar? Their experience in room 217 inspired the novel, The Shining, and later the Stanley Kubrick film, The Shining. By the way, the exterior shots of the Overlook Hotel, which is the fictional hotel in the book and the movie, were filmed at the Timberline Lodge on Mount Hood in Oregon, while many of the interiors were adapted from the Ahwahnee Hotel in Yosemite National Park. Here's our real estate trivia question for this week. Where's the world's largest road runner? Yeah, the largest road runner in the world is somewhere. It has to be. Where is that? Now, this isn't an actual living, breathing road runner. This is a statue of a road runner.
Oh, I thought it was a car.
No. It's a big old road runner, and it exists somewhere on Earth. Where is that? If you think you know or want to take a guess or just quickly look it up, you can send your best guess to trivia at realestateguysradio.com. That's trivia at realestateguysradio.com. Include your name, the answer to the question, and your physical mailing address so that if you're the winner, we can send you out Second Chance by Robert Kiyosaki. That's today's real estate trivia question. It's Ask the Guys, the questions that you've submitted and our answers. The next one comes from Sean in Fort Myers, Florida. Hey, there's the trifecta.
Yeah.
What is our recent listener uptick in Florida?
I don't know. We just came from Orlando. Where were you folks? Why didn't you come out and see us?
This says, hey guys, love the show. Thank you for giving away so much amazing information. I've been researching real estate investing for some time now, and it seems like wholesaling is a fantastic way to get started, especially being a fairly young guy with little capital to put down. However, I've read some conflicting stories about the legality of it and whether or not I would need to be licensed as a realtor in order to be paid for signing a contract to a third party. Do you have any further information regarding the laws around wholesaling in Florida or any contacts which I could reach out to for legal assistance? Thanks in advance with your help and keep up all the good work, Sean. All right, Sean. Well, first of all, let's talk quickly about wholesaling. It's the idea of you getting into contract to buy a property that you're not actually going to close on. You're going to have someone step in and do that. And as a business, it can be very lucrative. If you're out there and you have a lot of time and you know a market and you don't necessarily have a lot of money, you can go vet and find deals for folks who are in the opposite position. They're busy, they're doing deals, they don't have as much time to look. They will eagerly take a property off your hand for a small fee. So that's the concept of it. It can make a lot of sense and it can be a great way to get started. The legality portion, well, that's a little tricky.
Well, first of all, we're not lawyers. I think we said that at the top of the show. We're going to say it again. We're not lawyers.
And we don't even play them on TV.
Yeah, and we never even stayed in a Holiday Inn. Well, no, I'm kidding. Anyway, as far as Florida goes, the smartest thing to do if you're really concerned about it is to take a few dollars and go ask a real estate attorney the question and tell them exactly what you want to do, and they will tell you exactly how to do it. I'm going to guess, and that's all it is a guess, that it's fine. Because what you're effectively doing is entering into a contract with a principal as a principal. You are making the contract, making the offer in the first person. You're not representing anybody. So to have a license, a brokerage license, or to work under a broker's license with a sales license means that you are brokering. In other words, you are representing a third party. But in this case, you're representing yourself. You're going to make the contract in your own name and or an assignee or a nominee, depending on what the language your attorney tells you you should use in your particular jurisdiction. You're going to go find somebody that would like to have you assign the contract to them, and they are going to pay you some type of a bump, if you will, $5,000, $10,000, presumably because you got a great deal. What you're effectively being compensated for is tying up the property in contract at a decent price and then finding an investor who actually wants to close on the transaction. Now, we could spend a lot more time talking about the pros and cons of doing that, but we won't because we've done that in the past. But to answer your specific question, the smartest thing to do when you want to know legally, if you have a legal concern, is go spend a couple $100 and go see a qualified real estate attorney. It's cheap insurance.
Absolutely. And there might be reasons to consider becoming licensed in order to earn commissions and referral fees. But I'm guessing that if that's not your primary focus, that might just be a diversion. Instead, seek out counsel and get the right answer. We know lots of folks who wholesale and have figured out a way to legally do it in their areas. So good stuff. All right, this question comes from Patrick in Belgrade, Montana. Your book, Equity Happens, had a huge impact on me taking action to build wealth, and I love your podcast. During your next Ask the Guys segment, please consider the following question. Well, Patrick, we in fact have, as you can see. As someone who loves fixed interest rate loans backed by real estate, I'm making a big bet on inflation. Deflation could hurt me pretty badly. Not only eliminating equity, but reducing rental rates will cut the all-important cash flow. Looking at the history and trajectory of the U.S. dollar, one is tempted to think that its value can only go down. However, looking at Japan's lost decade and the fact that their yen, banking system, and investments are so structurally similar to the U.S., is it possible that the U.S. could have a lost decade of deflation? Well, it's possible.
Anything's possible, and you really don't know what's going to happen, but nothing's a straight line. So the 100-year trend for the dollar is down. And so if you're investing for the long term, which is what a 30-year fixed loan would be, I think the trend is your friend. But that's just an opinion. There are people who say the dollar is doomed. Peter Schiff talks about it. Jim Rickards talks about it. A lot of people who are into gold and are trying to make the case for gold are saying that the dollar is doomed. With that said, several years ago, we had Steve Hochberg from Elliott Wave, and he was the first person who really told us, yes, there's going to be inflation, but before there's going to be deflation. That is, the dollar is going to get stronger before it gets weaker. And sure enough, that was true. And it makes a lot of sense when you think about it, because if you look around the world and you look around at the economic uncertainty globally, when global investors are looking for a place to hide, they run to the dollar. So even though the dollar is flawed, compared to other places in the world, it's less flawed. But if all of the currencies are shrinking or sinking, which I think you can make the argument is the case, then long term, the dollar will be in the same ship. So that means that the probability, I say if I had to bet 50-50, I think you got a better chance of inflation rather than deflation. With that said, you do need to be prepared for a pullback because as inflation begins, it literally curtails economic activity. And when economic activity is curtailed, it slows the economy down and things, even though the dollar is getting weaker, even though the yen has gotten weaker, in fact, it gets stronger because the economy has gotten so weak in terms of demand.
Well, and the point of that is it's not just all about cash flow and rents. You get to a situation like you're describing, Russ, and people move out. It doesn't matter what the rent is because you have a vacant unit. So it's not, I mean, this is hard to get your mind around too. So if you're new to thinking about what the dollar is valued at or whatever currency, with the podcast heard in more than 190 countries, we have different currencies and people transact. Although in a lot of markets around the world, people use the dollar as the de facto standard for real estate purchases. I'm not talking about reserve status, just for real estate purchases. But the dollar changing is a daily thing. And we've had a strong dollar for the last few years. A lot of folks out there saying there's going to be a weaker dollar. As a real estate investor, you do need to be prepared to weather either side of that storm.
Well, here's the thing, a couple things. First of all, if you structure yourself conservatively, and I mean when I say conservatively, I'm talking about where you're not razor thin on the cash flow.
Right.
Number one. Number two, and probably should be number one, is that you've picked markets that are likely to be more in demand in a deflationary environment. In other words, as people get poorer, as their purchasing power declines, as they have less income, even though prices are dropping, where are they going? Where would they go? And they probably would go to places that are cheaper, where there's less taxes, where the cost of living is lower, but the quality of life is still pretty good. If you listen back to many episodes of the show, as we've talked about this, we've talked about some of the markets we like and why we like them. The other thing is when a country is getting poorer, they don't have the ability to create infrastructure. So you need to go to places where great infrastructure already exists because that will be more popular than places where there is no infrastructure, would need to be built, or when the infrastructure is in such poor condition, it needs to be rebuilt. So these are big strategic decisions to make, but this is a big strategic question. So the last thing I want to say on this point, if in fact you or anybody listening to this right now is serious, really serious about trying to understand how to strategize about these big macro things, it's more than we could cover in a segment on an Ask the Guys show. It's more than we could cover in a newsletter or a blog. It's more than we could cover in an entire episode. That's why every year we dedicate an entire week to it, where we get the biggest brains that we can collect on the planet on a ship for a week on our annual summit at sea. And this is exactly the kind of things we talk about. This is a lot of the things you hear us talk about on the show. You know, gosh, how do you guys understand all this? Because every year we commit ourselves to spend a week in intense discussions with super sharp investors from all over the world, stimulated by some of the greatest minds, not just in real estate, but in economics and banking and commodities and other things. And they all come together and we get a 360, as best of a 360 as we can on all of these different topics. And then we come out of that with actionable intelligence. Doesn't mean we're right, but I'm guessing we're probably going to get it right more often than people who aren't there. So if you're serious, and it's a big investment of both time and money, but if you're serious, you need to put yourself in a position where you can have that kind of experience. We create it for you. We invite you to join us. We're going to sell out with or without you if you're listening. So it's not, we're trying to recruit you because we need you, but we want you there if you're the type of person that is interested in seriously thinking about these kind of things, because you're going to have value to bring to the conversation.
Oh my gosh, we have a great time too. It's the 15th Annual Investor Summit at Sea, April 1st through the 9th. So it's actually 9 full days, 7 of which are spent on a beautiful, luxurious cruise ship. All the details on our website at realestateguysradio.com under Summit. It's Ask the Guys. Your questions, our answers today on the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Hi, this is Patrick Donahoe of Paradigm Life. Wall Street and banks spend billions of dollars per year in advertising with the goal to convince you that they are the solution. But take a look around. None of their advice has worked. The number one concern of all Americans is still money. So are you ready for another way? I've spent the last 10 years teaching people like you a superior way to build wealth and financial independence outside of Wall Street. I've developed a free e-learning program called Infinite 101, where you can learn about the perpetual wealth strategy. In this free program, you'll learn how to build your wealth without a 401k, IRA, or mutual funds. You'll also learn how to establish private financing without ever having to walk into a bank again. These are just two of the many ways this free program can propel you toward financial independence. Simply go to paradigmlife.net and click on the register button on the top right corner of the page to gain instant access.
Hi, this is Kim Kiyosaki. I'm the author of Rich Woman, and you are listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. No matter how you listen, tell a friend about the Real Estate Guys. It's our post-election Ask the Guys show. Nice to have that behind us. Our next question is a bit similar in nature to the one we just answered, and there might be a bit of overlap, but I think it's worth exploring. This comes from Andrew in Yucaipa, California, and he says, "What's up, guys? Your show is my favorite. I look forward to it so much that I find myself refreshing my podcast feed on Fridays." Wow. I'm starting Your Book Equity Happens and excited to someday meet you guys. I'm a 31-year-old beginner partnering up with my father to start in real estate investing, and I'm basically trying to learn as much as I can, as my father has started to trust me with a part of his retirement side money to get into real estate. I'm currently residing in California, but found out-of-state investing more attractive than in-state investments. As I look into the markets such as Texas and Colorado, I'm a bit nervous about the economy and the fact that everyone and their mom are jumping into real estate. Even though I can be grouped into that group, I'm getting quite nervous. I would love to hear your opinions about beginners getting into the current market. Thank you, Andrew. All right, well, the reason I think that this has some overlap is we're looking at not only what may be happening with the currency and inflation and deflation, but just as real estate trends and timelines go, the markets are cyclical. And where we are in many, many real estate markets is closer to the top than at the bottom.
That's right. That's absolutely true. Now, with that said, it means that you approach the market differently. It doesn't mean that you stop investing. And so what worked in terms of buying properties in great markets below replacement cost at the very bottom is different. Back then, there wasn't a lot of cash out financing for any equity you might be fortunate enough to have.
Or really much financing at all.
For people that had no equity, there was tons of inventory, and that was, you had to approach that market a different way. Today, you need to approach the market a little bit differently. And so if you structure your portfolio, and one property at a time, one market at a time, if you structure your portfolio to weather a storm, and now we know how big a storm can happen, I think it's reasonable to think that you could survive that storm. If you are betting on the availability of financing to take you out on a speculative play, and you're entering the market right now saying, hey, it's run up X amount and it's going to keep going, I would be cautious about that type of a strategy. Now, if you're conservatively financing it and you're structuring it in such a way so there's solid cash flows and you've picked a good market and a good demographic to serve at a right price point, and you have maintained adequate reserves so that if something were to go sideways, you can get your way through it, and you're not in a place where you might have to sell the property if there was a downturn. You never want to be a have to sell. You want to be able to sell on your own timing, not based on the market time. I know this from experience because I had a portfolio structured for sunshine when storm was coming. I didn't see the storm clouds. But it doesn't mean I stopped investing. It just meant I recognize better where we are in cycles and how to structure things.
So we talk about recession-resistant markets and product types, and that's the way to think. When times are good, people in the lower tiers of, say, apartments can move up a little bit because they're getting raises and they're feeling affluent. And when times are bad, people in the upper tiers can move down, and there's that middle area where no matter what happens, people need to have a roof over their heads, and they will do what they need to do, and there's a lot of places. So I would stay away from super high-end stuff, and I'd probably stay away from stuff at the very bottom too, because that's capital intensive. But bread and butter real estate will out in almost any market.
Well, what you just said, Robert, about product type, about, not being in the high and not being in the low, but being in the middle. Think about states that way. Think about markets that way. It's exactly the same. There are markets that maybe are a little bit red hot, and there's markets. And when I say markets, I'm talking about, metros. I'm talking about big markets. And then inside of those markets, you have to get in and figure out where the pockets of opportunity. Even in red hot markets, you're going to find situations where, because of a personal reason, there's a death, a divorce, there's some level of stress, bad management. You're always going to be able to find diamonds. You're always going to be able to find gems that you can invest invest in. So again, it's easy to look at things in the macro and make decisions about to be in the market or not be in the market, but real estate is not a market and it's not a macro. These are individual opportunities, but your chances of finding those diamonds, those gems, are going to be dependent upon whether the mine or the vein that you're operating in is more populated with those types than others, or more likely to be. So you want to pay attention to the big market, but you also want to get good quality relationships with solid people, boots on the ground team that know the neighborhoods right down to the street level, that have their eyes out for you, that can find you that right deal. And then you need to have yourself positioned so when it shows up, you can move fast, because they're often those deals will go to the person who can pull the trigger the quickest.
Such good questions today. We had way more than we could get to as usual, but thanks to everybody who submitted their Ask the Guys question. We'll be doing another Ask the Guys show in the next 8 to 10 weeks. Next week on the Real Estate Guys, we have an amazing show for you. One of our favorite guests on planet Earth will be with us next week, so make sure you tune in for that. And if you're looking for any kind of clarity, not just questions about real estate, but really the bigger picture, which is what is your life all about? Where are you going? Where do you want to be 5 years, 10 years, 20 years from now? How do you want to create abundance and wealth and great relationships in your life? We would urge you to come on out to Create Your Future. It's our 2017 Goals Retreat. Happens the first weekend of the new year in San Diego, California.
Let me just say a little bit about how this fits into your overall investing, because we're an investment show and you think, well, what does this have to do with goal setting and all that? Well, if you really think about it, the reason you want to invest is because you have goals. The reason you want to invest is because you're trying to fund a lifestyle. Most of you probably wouldn't invest or make money if you weren't going to use it for some purpose. In an ideal scenario, you design your money-making goals, whether it's working or investing, around a lifestyle you'd like to live. We did that resort property investing webinar. We're just talking about why we got involved in resort property investing. It's because it's a product type we like. It's in an area we like. It lets us live a lifestyle we like. Is it the world's best investment? No, it's a great investment, but there's maybe other ways we could make money. But we built our investing philosophy around who we were, who we wanted to work with, how we wanted to live, how we wanted to spend our time, where we wanted to go. If you don't really know the answers to those questions, then you may go build an empire like that guy we met in Las Vegas that was making $1 million a year of passive income, netting $1 million a year. Most people think that's the holy grail. Man, if I could just build a portfolio where I had $1 million a year. This guy woke up and hated every single hour of his life. And he was meeting with us hoping we would take the property off his hands. How do I get out of this mess I've made? And we said, you should go figure out who you are, what you want, cash out of this, and then go build that life. Because obviously you got so busy making money, you never had time to figure out who you are and what you wanted the money to do for you. So you got the money, but it wasn't really what you were after. That's what the Goals Retreat is all about, keeping you from making that humongous mistake.
You'll find more information on our website at realestateguysradio.com under events. Big thanks to all the folks who submitted their questions today. If you have a question for the next edition of Ask the Guys, go to the website at realestateguysradio.com, click Ask the Guys. Until next week, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors. From attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.